Imagine you have $100,000 sitting in your bank account right now. Every single night, you feel a sense of safety knowing it is there, untouched, and protected. But what if that very safety is actually costing you a fortune? What if the thing you think is protecting your money is shrinking its purchasing power while you sleep? Right now, the best high-interest savings accounts are paying around 5% a year. On your $100,000, you might earn roughly $5,000 in 12 months. That feels like progress, but inflation is running at over 4%. This means the cost of everyday things, groceries, power bills, and your morning coffee, is rising at almost the same pace. When your savings grow by 5%, but prices jump by 4%, your real financial gain is minuscule. Your money is barely treading water. In years where inflation climbs higher than your bank's interest rate, your money actually moves backward. You have more dollar bills, but those dollars buy less. Now look at the alternative, the share market. Over the last 30 years, Australian shares returned an average of over 9% every single year, while cash in a savings account averaged much less. Let's see how that impacts your $100,000 over a 30-year timeline. If history repeats itself, the money left in a standard savings account grows to roughly $336,000. However, the portion invested in the stock market grows to about $1.4 million. That is the massive difference between a tight retirement and a truly comfortable one. In the first few years, the gap between the saver and the investor looks small, but compound growth builds slowly and then explodes. The investor earns returns, then earns returns on those returns, and the financial snowball gets bigger and faster every year. Of course, the share market comes with volatility. It crashed during the dot-com bust, the 2008 global financial crisis, and the 2020 pandemic. Some years, you will see your balance drop by 20 or 30%. That fear is completely real. However, after every single crash in history, the market recovered and climbed higher than ever before. The long-term average return already bakes in those terrible years. The investors who lose money are not the ones who stay in, they're the ones who panic, sell at the bottom, and lock in their losses. The real long-term risk is keeping all your wealth in cash and letting inflation eat it alive. Smart money management is not about choosing one or the other. It's about giving both cash and stocks the right job. Your savings account is an excellent tool for your emergency fund or short-term goals, like a house deposit you need in the next couple of years. Nobody should invest money they need within the next 3 to 5 years. But for money you won't touch for a decade or more, leaving it in a savings account wastes its potential. Take an honest look at your $100,000. Keep what you need for the near future safe in your bank. For the rest, low-cost index funds let you own a slice of the global market. Your money is a seed. You can lock it in a jar where it stays dry and the same size forever, or you can plant it in the market and give it the time it needs to grow.